Lower oil prices are colliding with stubborn inflation and fiscal worries, leaving asset prices finally balanced across the board. Welcome to vTalkInsight, Allocator's Lens Daily for May 26, 2026. Today the focus is how hopes for a Middle East breakthrough, shifting central bank expectations, and powerful structural themes like AI and healthcare are reshaping risk and opportunity across equities, rates, credit, foreign exchange, and commodities. Equities are leaning into a risk-on mood, with global indices hovering near record highs while crude prices retreat on signs of progress in U.S.-Iran talks. Lower energy costs are easing one of the big macro headwinds for corporate margins and are feeding a broad rally, especially in Europe. In Europe, cyclicals are back in favor. Travel, leisure, autos, and construction names are outperforming as falling oil prices improve the outlook for fuel and input costs, and as optimism grows that a partial reopening of the Strait of Hormuz could stabilize energy supply. Airline stocks have jumped, with carriers in Europe and globally benefiting from cheaper jet fuel and relief after months of disruption risk. This rotation is coming at the expense of energy majors, where lower crude prices are pressuring share performance. The move underlines how sensitive European equities remain to energy swings, given the region's status as an importer and its recent history of shocks to supply and shipping routes. It also highlights the internal dispersion within indices as beneficiaries of cheaper oil and gas diverge from producers. Corporate news is adding fuel to the equity bid. A potential multi-billion-dollar takeover of Delivery Hero by Uber and a possible bidding war with DoorDash have driven double-digit gains in European food delivery stocks and reinforced the idea that strategic buyers are willing to pay up for growth assets. At the same time, developments in semiconductor technology, including Huawei and Chinese foundries narrowing the gap with global leaders, are feeding expectations of a more diversified global tech supply chain. Beneath the day-to-day macro noise, structural themes remain important for equity allocators. AI is transforming healthcare with faster drug discovery, AI-driven diagnostics, and the convergence of data platforms with GLP-1 medicines pointing to new business models in preventative and patient-centered care. These trends underpin a constructive long-term narrative for AI-native healthcare companies, even as surveys suggest management teams may be overestimating near-term productivity gains and workers worry about job displacement. Set against this upbeat equity picture, there are clear fault lines. Europe faces sub-1% growth this year, lingering energy vulnerability, and rising concern about policy error as the ECB prepares another rate hike despite soft activity. Bond markets are more cautious than equities about inflation and fiscal trajectories, and health risks such as the worsening Ebola outbreak could reintroduce travel and trade disruptions. For now, though, lower oil and resilient U.S. growth around 2% keep the equity mood constructive, with the key question being how long this divergence from more nervous bond markets can persist. Rates markets are caught between a short-term relief rally and a structurally tougher backdrop. European government bonds are in demand, with core yields moving lower as oil prices fall and markets dial back the most extreme energy shock scenarios. There is even talk that the recent rally in long-duration paper, especially in Germany and the U.S., could extend modestly as investors seek a breather after heavy selling. Yet the policy story is far from easy. Eurozone headline inflation has risen to around 3%, and the ECB is expected to raise its inflation outlook again, with forecasts near 3.5% in the second half of the year. A June rate hike is seen as highly likely, and some officials risk pushing into restrictive territory above 3%, even as growth hovers near zero, raising clear fears of stagflation and potential policy error. In Japan, the picture is the mirror image. Japanese government bond yields remain low relative to domestic inflation and far below Taylor Rule estimates near 3%, signaling that the Bank of Japan is still well behind the curve. JGBs trade at a noticeable discount to U.S. Treasuries and UK gilts after currency swaps, reflecting market skepticism about how quickly Tokyo will normalize policy. For the U.S., upcoming core PCE inflation data and the swearing in of a new Fed chair are key waypoints. A sustained drop in oil linked to a U.S. Iran deal could ease inflation pressures and support arguments for an eventual pause or even earlier rate cuts, whereas a breakdown in talks and renewed energy spikes would keep the higher for longer narrative alive. Front-end yields are most sensitive to these developments, while long-term yields are likely to remain supported by elevated real rates, fiscal worries, and persistent geopolitical risk premia along the curve. Credit markets, particularly in Europe, are starting to flash more amber lights. A recent bond sell-off was driven in part by anxiety over high public debt and large deficits, raising questions about fiscal sustainability and inflation expectations. Investors are differentiating more sharply between issuers, with German government bonds seen as relatively resilient and offering sustainable inflation-adjusted returns, especially at the long end. At the riskier end of the spectrum, Turkey stands out. Political turmoil, early election talk, and clashes within the opposition have heightened uncertainty just as the central bank defends the lira by selling dollars into a backdrop of inflation above 30% and heavy energy import needs. Each $10 move in oil has a material impact on Turkish inflation and the current account, making the country a clear case study of how geopolitical and commodity shocks can quickly morph into credit risk. Foreign exchange markets are increasingly trading off central bank credibility and energy exposure. The Japanese yen remains a barometer for confidence in the Bank of Japan's normalization path. If rate increases continue to lag domestic inflation and global peers, the risk is for further yen weakness, which would amplify imported inflation and eventually force a sharper policy adjustment. In Turkey, the central bank's defense of a lira through sizable dollar sales is straining reserves and underlining the fragility of currency pegs in the face of political shocks and energy price swings. More broadly, a medium to long-term weakening of the U.S. dollar is expected unless the Fed resumes rate hikes, which would gradually reduce the dollar's dominance in global portfolio allocations. For allocators, this points to a currency landscape where policy choices and terms of trade matter even more than usual. Commodities, and oil in particular, remain the core macro swing factor. Brent has fallen by around 4 to 6%, dipping below the $100 mark, as markets react to signs of progress in negotiations between the U.S. and Iran over reopening the Strait of Hormuz. Increased vessel traffic, including oil and LNG tankers, hints at a partial easing of shipping disruptions, even though flows are still well below pre-conflict levels. However, the story is far from one way. Iranian officials have downplayed the imminence of a formal agreement. Previous ceasefire efforts have proved fragile, and the strait formally remains closed. So the current price move is largely about reduced odds of immediate escalation rather than a full normalization of supply. Any breakdown in talks could quickly reverse the recent decline and reintroduce a volatility spike across energy and transport-sensitive assets. Looking beyond the near term, Europe is doubling down on energy security. Small modular nuclear reactors are gaining prominence in strategy discussions as a way to reduce dependence on imported fossil fuels, lower project risk compared with traditional nuclear, and support net zero goals. This reinforces a long-term investment narrative around modular nuclear technologies and associated supply chains, even as near-term oil prices still dominate inflation and policy debates. Finally, the worsening Ebola outbreak in parts of Africa is a reminder that health shocks can disrupt commodity flows and transport. Flight cancellations, enhanced screening, and equipment shortages raise the risk of localized trade bottlenecks, which could interact with already strained supply chains if the crisis were to escalate further. For now, though, energy geopolitics around the Strait of Hormuz remains the dominant driver of commodity-linked macro uncertainty. Across assets, the picture today is one of partial relief rather than resolution. Equities, especially in Europe, are embracing lower oil prices, upbeat corporate activity, and powerful structural themes in AI and healthcare, even as growth remains weak and headline risks from geopolitics and health crises linger. Rates and credit markets are less sanguine, balancing a tactical rally in long-duration bonds against persistent inflation, heavy sovereign deficits, and policy divergence between the ECB, the Fed, and the Bank of Japan. In currencies, the yen and lira highlight how central bank credibility and energy dependence shape FX risk, while the medium-term prospect of softer dollar hints at a gradual rebalancing of global portfolios. In commodities, oil still anchors the macro narrative, with every headline out of the Strait of Hormuz feeding directly into inflation expectations and central bank reaction functions. Key variables to watch now are progress in U.S.-Iran negotiations, the upcoming U.S. core PCE print and new Fed leadership, the ECB's next meeting, and any signs that today's health and political shocks start to affect real activity and credit conditions. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.